All right, good morning, everybody. Happy Saturday. Today is Saturday, January 9th of 2021. Happy New Year as well to all of you joining in. Looks like we've got more folks jumping on now. Jordan, welcome. Thank you for joining us here on this Saturday. As usual, we offer a monthly webinar here as part of our Redeem Team Mastermind. And so today is the second Saturday of the month, and so welcome on everybody. Eddie, welcome on. I'm excited to have on with us today Mr. Bryce Gill, economist with First Trust Advisors. I'll introduce him some more here in a minute, but just by way of background, during our last MAGS session for the members only, it was brought to my attention that it might be good to have someone, an economist in particular, talk about economic outlook for the rest of the year, given all the different factors and different things that are happening. And so after a little bit of research, it just so happened that Bryce and I had some connections, and we connected on LinkedIn, and he was kind enough to join us today. And so I'm glad that he is doing exactly that. As far as, let me go to the next slide here, just a quick disclaimer for everybody. I think a lot of you guys know this. I'm not an attorney. I'm not a licensed investment advisor. I'm not an accountant. I'm certainly not an economist like Bryce is. All the information that we're sharing is simply from our experience and intended for educational purposes only. And so be mindful of that. And really, with regards to pursuing any type of investments, definitely want to seek out professional support like the ones I just described. A little bit about our company. So Redeem Investments is the name of our company. Our tagline is renovating properties, transforming lives. That's really what we fully intend to do with the acquisitions that we're making across apartments and, other arenas. We really feel like by redeeming properties, especially apartment units, which are communities in and of themselves, and renovating those, we're able to transform lives for the residents that reside there, but then also for folks that partner with us to invest in those properties, as we aim to provide them with cash flow producing properties in the form of income, as well as growth and appreciation and things that would help better their financial picture. So really glad to be able to do that. Our company does consist of a couple of different areas, and so I want to talk about that. Really, the first is Redeem Commercial Real Estate. And so that's really the segment of our company that focuses on apartment building acquisitions, whether they be buy and hold for the long term, where we force appreciation and retain those after an exit of some type, like a cash out refinance or a recapitalization. We also provide concierge services. So at those same apartment properties, we offer services that those tenants would otherwise have to source on their own. These things include energy services like electricity, telecom services, internet services, etc. We also have our Redeem Team Mastermind, which really is the format for which this webinar takes place. One of the features of the webinar one of the features of the Redeem Team Mastermind is educational resources. So by bringing on folks like Bryce to talk about things that are going on within their particular space, we're adding value to our members because of the things that they're learning. They also have access to resources and marketing and other things, in addition to really the biggest component of all, which is the opportunity to joint venture partner on deals that we acquire and that we're pursuing. And then the last piece is Redeem Realty Solutions. That's really the residential real estate arm, where we started a couple of years ago. We were in the process of sort of reviving that, actually, and bringing that back online with one member of our team who is a licensed realtor who will be pursuing those opportunities for us. Going back really quickly to the Redeem Commercial Real Estate, one of the things that we're very excited about that will be taking place over the next 3 to 6 months is the launch of our real estate investment fund, which would enable us to acquire more deals at a faster pace, perhaps even larger deals, because of the dry powder, if you will, that we're able to accumulate in advance of finding the deals. So, one of the two questions I usually get is, what is the mastermind and how can I participate? So I just want to touch on that real quickly before we transition. So in effect, like I said, the mastermind is a JV partnership program. It's really ideal for those who are aspiring to become general partners or sponsors for large apartment deals like we've been doing, and even larger. Having access to those things that I mentioned, various resources, training, meetings and events for educational purposes, as I mentioned. It is limited to 50 members. And so, we are selective about who is part of that group. And as far as who our members are now, I'm excited to share with you, there are 6 that are West Point grads. Our newest member is a Naval Academy grad. Won't hold that against him. Apartment syndicator and business executive, single family home, short-term rental investor, single family home rentals, orthopedic surgeon, real estate investor, retired Air Force NCO, non-commissioned officer, real estate investor. He's a data scientist, compliance officer, commercial mortgage broker, a nonprofit leader, and Amazon delivery entrepreneur, logistics mastermind. So a lot of different folks from different spaces that just really come together to form our mastermind, and the amalgamation of all the different backgrounds really helps to reinforce the type of intellectual capital I think that's needed and that's beneficial for us as we aim to pursue larger deals as a team. I do want to share this with you just very quickly, just to give a sense for the number of LOIs that we submitted just in the last really 5 to 6 months of last year, the size and scope of what those deals are. And just to give you a sense for the size of the units, the price that we submitted, and really the mastermind is what gave me the confidence to be able to pursue these types of larger deals. The size of the deals that we have in our portfolio now range from 32 to 56. Obviously, many of these are much larger than that because of the mastermind and because of the resources, the collective resources and the network that we have. We're able to pool the funds together in order to pursue these types of deals. Now, clearly, we didn't, close on any of these deals. There's very many reasons for that. What's interesting in the space now, for example, is just the overwhelming desire, it seems, for other folks that we compete with and other groups to pay retail or maybe even overpay in order to acquire these assets. Bryce may even touch on some of that, where some groups may be looking to place money simply for tax purposes, maybe not for cash flow, but for other reasons beyond the objectives that we have in mind. So, but I did want to just share that very briefly, just to show you and give you a sense of the types of deals that we are pursuing. How can I participate? Again, this is another question that I usually will get. So, you can go to our website. You can send us an email at invest@redeeminvestments.com. For those interested in joining our mastermind, this is the link. And again, it's not for everybody. It's not for sort of the person who just wants to be a limited investor with us. But if someone is planning on being a limited investor in terms of a limited partner and wants to get access to those resources that I mentioned, this is a great thing to consider as well in order to learn how to be a general sponsor or general partner or sponsor at some point in the future. And then as far as upcoming events, we had our last meetup here a couple of weeks ago in Dallas. We did a property tour of our recently renovated property in Arlington. That was in conjunction with the Dallas Cowboys game against the Niners. Today we're having our MAG session in February. One of the things that I really want to do is showcase to everyone our acquisitions process. And so our acquisitions team will effectively be our guest speakers for that session. So I'm excited about that. We'll have our next mastermind meetup sometime probably in March. And then I'm trying to get our tax strategist back on the horn in March to talk through tax strategies as we approach the tax season and the filing date for that. The last thing I'll mention now is, we are offering a semi-annual retreat. So mastermind members get access to the same rates that we get, which is about 50% or more off on these almost 7-day long vacations that are in places that are all inclusive. And so in those sessions, we're able to have business discussions and be a mix of both business and pleasure. So that said, let me go ahead and transition to Bryce. He is an economist, like I said, at First Trust. He actually resides here in Austin, and he'll tell you a little bit more about himself, but I'm just excited that we were able to connect within the last couple of weeks here, and he was kind enough to join us. So Bryce, let me turn it over to you, and then I will share presenter mode as well.
Okay, well, hey, thank you, Christian, for the introduction. Thanks everybody for joining us on the call today. I'm going to go ahead and pop my slides up, and then I'll do a little, brief introduction of, who I am and what First Trust is. So, I work as an economist at a company called First Trust Portfolios. We are a privately owned asset manager. I believe we're actually one of the biggest privately owned ones in the country. We manage about $150 billion. Our specialty is essentially actively managed exchange traded funds and unit investment trusts. So, my job on the economics team is to talk to financial advisors across the country and just kind of give, my value add is to basically, show up and talk a little bit about the macro situation in the country, talk to people about, strategies, what the economic data is saying. Specifically, I write on housing and industrial production every month. So this is actually, a good topic for me. I've been following the real estate market in the United States for, professionally for the past 10 years. 2020 was, a lot of stuff happened, right? And there was certainly a big impact on the real estate market. I think it's interesting to kind of talk about going forward, what the trends are going to look like, because I think there are a lot of opportunities in real estate as an asset class as we kind of head into the post-pandemic world. So we'll get into it a little bit. We'll have plenty of time for Q&A. I'm happy to hang around and answer any questions people have afterwards as well. It doesn't have to be about real estate. I'm happy to talk about, pretty much anything when it comes to the U.S. economy. So, the first thing I wanted to talk about is, I titled this slide "Winners and Losers from COVID-19 so far," because, really what we've seen is sort of an exacerbation of trends that were already happening in the United States for kind of the past, 3 or 4 years is really when it started happening due to the Tax Cuts and Jobs Act. But what I've got here is just kind of a color-coded map of the U.S. With resident population changes between July 2019 and July 2020. That's the data that we have right now from the Census Bureau. We'll get more as we kind of go forward. But what you really notice is that the big losers have been, California, New York, and Illinois, and the big winners have been, Texas, Florida, and then kind of, look at the southeast coast. In places like Nevada and Arizona. So, a lot of people are going to look at this and I guess the first thing you kind of draw a conclusion from it is, hey, whatever, people are saying about the political situation or the lockdowns or whatever it is, the way they're voting with their feet is it seems like people are leaving these kind of more severe pandemic restriction states for kind of the less severe pandemic restriction states. So, and this is, again, I kind of talked about how this is an exacerbation of pre-existing trends. Some of you guys may remember that the Tax Cuts and Jobs Act, when that was passed, the big thing was it lowered corporate tax rates, right? But kind of the other major component of it was that it capped state and local tax deductions at about $10,000. And, this basically made high tax states, their residents really feel those taxes more than they had before. So we've been seeing for the past 3 or 4 years, people leaving kind of the East Coast, California, heading down south to Florida and Texas and, Georgia and Arizona. It's been going on for a while, and the pandemic and the lockdowns and things really exacerbated this. So I think, kind of knowing that going forward, I expect this to kind of continue. I think, people are leaving these kind of big cities that have kind of dominated technology and kind of all the growing industries over the past, 2 decades, really. We're starting to see a lot of these business migrating to new places. So I think there's a ton of opportunities real estate wise, but it does look like they're shifting down to states like Texas and Florida and various other places. The other thing that's kind of been going on is a shift between cities and suburban areas as well. So it's interesting in 2020 that the rental vacancy rate in the U.S. has actually been falling, which kind of I think surprises a lot of people because obviously we all know about New York and we know about Chicago, all these empty apartments, right? But what's been happening is basically people have been leaving those places and renting in other places, typically in the suburbs and areas with more space and less restrictions on their activity. So broadly speaking, city rental vacancy rates have gone up significantly, and kind of outlying areas have seen their rental vacancy rates fall. So again, now with kind of this work from home, this new dynamic that we have, I think post-pandemic, I don't think Chicago is dead or New York is dead, right? But I think a lot of these people are gonna, stay in Nashville or stay in Austin, Texas, or stay in Florida. I don't think we're gonna see a full return to these places. And now with work from home, you can basically be a part of a lot of these industries that typically required you to be, geographically close to a lot of other people. You can do it, from a distance now. So it's really kind of opened up opportunities for a lot of new real estate markets across the country.
Hey, Bryce, quick question.
Yeah.
So do you have the demographics further stratified? In other words, is it a certain segment of the population age-wise or, working age, et cetera, that are making these moves?
Yeah. It looks like mostly what's happening is it's kind of the younger professional millennials that have been, living in San Francisco or living in New York City. And during the pandemic, what it looks like to me is basically there was a kind of a shift in thinking because young people want to be in these places so they can go to, bars or restaurants or the theater, or museums, or, social life, basically. And it looks like, these are well-paid professional young people. And it seems to me that the pandemic really kind of changed their mindset. And a lot of them are now looking for, more space in the suburbs, single family homes, whatever it is. And that seems to be kind of who's driving a lot of this migration. It's not, it's the more well-off professional individuals who kind of have the money and the resources to make these shifts.
Sure. Thank you.
Yeah. So, a big question I've been getting a lot over the past year, or I guess, in 2020 specifically, is regarding this eviction moratorium that's been going on, across the country, basically, where, we're saying, hey, we're in the middle of a pandemic. We don't want to, the same kind of situation we had in 2008, right? Where all of a sudden there's all these people on the street. So, the government has basically clamped down and said, hey, if people aren't paying their mortgage, they aren't paying their rent, you're not actually able to evict them. And a lot of people are looking at that and saying, well, what happens all of a sudden when this eviction moratorium gets lifted, right? Is it all of a sudden going to cause a big cascade of economic issues? Because eventually, right, we can't have an eviction moratorium forever, right? It has to end at some point. So, it's interesting to me to see how different 2020 has been. And I'll kind of talk about the reasons for this. When you look at mortgage delinquencies and, people foregoing their rent payments. So what I've got here is the percent of U.S. mortgage balances that are 90 plus days delinquent. So this is really when you get in trouble with the bank, right? And you can see the huge increase we saw in 2008, 2009, right? But conversely, you look over at 2020 and we have kind of a little bit of an upward blip there, but we're basically at record low percent of U.S. mortgage balances that are 90 days delinquent. And people, I think, are surprised by this, but again, it looks to me that kind of the people that are struggling the most during the pandemic are, going to be the relatively, lower paid individuals, right? So they're probably going to have smaller mortgages on balance. And even if they are delinquent, there's a lot of people that are still paying. So right now, from what I can tell, looking behind the scenes, just at kind of the delinquency data, it doesn't seem to me that we're going to see a big wave of evictions that kind of causes, a double dip recession or kind of a repeat of 2008. So kind of a similar thing as well with rental income, right? I hear anecdotal stories about, buildings in New York City where nobody's paying and everybody's on forbearance and stuff like that. But, this is information from the Bureau of Economic Analysis. They basically take this from, building owners' tax filings. And U.S. rental income, if tons of people across the country, just in waves, were not paying rent, we would see a pretty significant reduction in rental income. And instead, similar to kind of the mortgage data, we saw kind of a little downward blip, but has since completely recovered. So, I think a lot of this just ends up being kind of anecdotal. I think, for the most part, real estate has remained a great investment throughout the 2020 pandemic, even with kind of all of this eviction moratorium stuff going on. So the reason for that is, guys, is that this is a recession unlike anything I've ever seen before. And I think this chart kind of shows why. The reason is that we fully replaced income in the United States, right? We had 23 million people become unemployed in 2 months. That everyone thought the Great Depression was going to happen, right? And when you look at numbers like that, it makes sense why. But if you look at the personal income data, back in 2008, 2009, we see incomes falling for over a year. We probably don't recover the income we lost as a country for 3 years afterwards. And you bring it over to 2020, and instead of income falling during this pandemic, it absolutely skyrockets. And the reason is because we boosted unemployment benefits, we sent out stimulus checks, we extended unemployment benefits to people that typically weren't included. So people in the gig economy, independent contractors, people like that. And kind of the result is that America, broadly speaking, got a raise in 2020. And we've never really done this before, right? This is the only recession I've ever seen or heard of where, households basically paid down debt, net worth went up, and households have been saving like crazy. There's a huge amount of cash just sitting on the sidelines right now in people's bank accounts, waiting for the pandemic to kind of end. So this is the reason why I think rental income has stayed so steady. It's the reason why mortgage delinquencies have remained muted. Basically, the federal government bailed the real estate sector along with tons of other sectors out because we didn't want a repeat of 2008, 2009, right? So that's I think why things have been relatively more smooth this time around. And this is far from without its problems, right? I think we do have some downstream effects that we could see, but this is why I think we're kind of set up for a good recovery in 2021. So I talked a little bit about kind of residential real estate. I do want to talk about commercial real estate really quick because I think this is kind of the area that's shaping up to have a lot of issues going forward. So what I've got here is online sales as a percent of total retail sales. So it's kind of a good proxy over time to see, how is brick and mortar faring versus, Amazon or, just online retail in general. So you can see that there's been a broad upward trend going on for, over a decade, longer than that, right? 20, 30 years, this has been happening. But we see the pandemic happened. It basically massively exacerbated this ongoing trend. And we probably got, 5 years worth of, online sales devouring market share from brick and mortar in like 8 months. And, it's come down a little bit. It'll probably come down a bit farther as well. But, the end of the story is basically, even after the pandemic ends, are people really going to be going to outlet malls as much as they were before after they just spent 2020, finding new places to shop online? I think we'll see a little bit of a return to normal, but I think demand for kind of brick and mortar retail is going to remain kind of clouded and depressed over the next couple of years. And this is the kind of area that I'm most worried about. I don't know what we're going to do with all these empty strip malls and outlet malls and stuff like that. But that's kind of the area where even after the pandemic, I don't think a return to normal is going to bring brick and retail back to where it was pre-pandemic. I think we've kind of seen just an acceleration of the shifts that were already happening. So the other big thing that kind of happened in 2020 is I talked about all those kind of younger professionals moving out of the big cities, and really what we've seen is U.S. housing sales have kind of broken out. So what I've got here is existing plus new home sales, so the total amount of homes sold, and you can see kind of like starting in 2015, the upward trend here broke down, right? People were basically stopped buying more and more new homes. We had basically a flat line in the trend for probably 5 years there. And we saw a huge decline when the pandemic first started, right? There's a huge decline in every piece of economic data. But since then, the big bright spot, and I think the thing that surprised people more than anything during 2020 is how powerful and how strong the housing market has been. And part of that is obviously the Federal Reserve. I talked about, how they helped kind of send out checks to everybody. And that's kind of also, shown up in mortgage rates, right? Mortgage rates are at record lows. So even with home prices rising, affordability is probably, more than what it was at the end of 2019. So it seems to me like a lot of millennials that were kind of, stuck in the mindset of, hey, I'm just going to live in the big city for the rest of my life. This kind of changed a lot of people's minds and has really caused a huge surge in home sales that a lot of people weren't expecting. And this is kind of a trend. Again, I expect that. I don't think New York City's dead. I don't think Chicago's dead, but I do think they're going to lose a lot of their younger population who are just going to kind of move to Nashville, move to Austin, Texas, and get a house in one of these places. I think basically the preferences of consumers have kind of shifted towards single family homes, at least in kind of the short term. And I think, even as we head into 2021, the demand for housing has been insane, and there just hasn't been enough to meet that demand. So I think we're going to continue to see more building, and I think we're going to see a shift kind of towards single family housing. And there, again, from a commercial real estate perspective, there's going to be plenty of opportunities, right? There's plenty of these kind of mid-sized cities that are growing out of control that are going to be great markets for this. But it seems to me a lot of these young professionals, we're always talking about how millennials are never going to buy homes, they're never going to have kids or anything like that. And it seems like the pandemic kind of caused a shift in preferences, and we just don't know how permanent it's going to be at this point.
So, hey, Bryce, that's a good point. That's one thing that I was going to ask you is the demographic of folks who are part of this surge of home sales or home purchases. Is it among the millennials? Is that what you're seeing as well? Because I think that's sort of some of the data that I was tracking is that a greater percentage of millennials and seniors, baby boomers, were looking to transition out of a single family home and into apartments or communal living, not communal living, but apartments and other types of places like that, as opposed to in a single family home.
Yeah, so I think there definitely are places like that. A lot of people still are going to want to live in the city after this happens. I think we're going to see plenty of people sell their homes, and if you're older, you don't want to have to deal with property, managing your property and doing all the maintenance and stuff. I think all that stuff will still happen, but if you look at something like the home ownership rate in the United States over the past 20 years, it's basically been on a constant downward trend, right? It's fallen from something like 67 to 60 at the end of 2019. So fewer and fewer people wanted the responsibility or wanted the headaches that came with owning a home. And this year, during the pandemic, we've seen basically that entire trend erased in 8 months. Now the home ownership rate has surged basically across the board back up. So does it mean that commercial real estate and rental properties are all going to die? Absolutely not. I think, again, there's tons of markets where people want to be. I think kind of the big losers are just kind of the traditional big older cities, like Chicago, New York, Los Angeles, San Francisco. I think the pandemic kind of jarred a lot of people's mindsets. And if you were on kind of you were living in San Francisco for 10 years working at a tech company, and all of a sudden your company's lifting, saying, hey, you can live wherever you want to. We're going all digital. Well, I think that person now, you're not tied to San Francisco anymore, and you can take, your money and go wherever you want in the country. And I think, a lot of those people, after being stuck inside, want more space, and they want, a house for themselves.
Got it. Speaking of money, a question came in here, Bryce, I want to pose now. Is there potentially a risk for the U.S. dollar to no longer be the reserve currency in the next 5 to 15 years due to the U.S. government issuance of debt that may never get paid back? I think it's a valid question. It's insightful. What are your thoughts on that?
I absolutely love that question. And I'm going to skip my next slide and just go straight to my inflation slide here, okay, because I planned to talk about this. So I'm really glad that question came in. So I talked about the stimulus, right? I talked about how we've replaced incomes fully. We've never done that before, right? Basically what's happening is the Federal Reserve is printing money and they're buying U.S. Treasury bonds, right? So there's all this new money is flooding into the U.S. economy. After 2008, what we did with quantitative easing and things like that, all that new cash just went straight to bank vaults, right? It was held in capital ratios and things like that. This time, and that's why there was no inflation after 2008, right? People are calling for hyperinflation from QE. It never happened. Well, so what we look at is called M2. So this is high power money. It's basically money that's likely to be used in transactions. So you can see 2008, 2009, there's no notable real increase in the M2 money supply. And this chart's back to 1960. It's the farthest back series I could find from the Federal Reserve. This year, the money supply has absolutely been skyrocketing. I've never seen anything like it in my time professionally as economist. And talking to the older, people on my team that have more experience than I do, this is kind of it's completely unprecedented. Especially versus 1970 or something like that. When we had the Vietnam War and the Great Society programs and things like that. So money supply has gone up by 25% in the past year. So, that is a crazy increase. And yeah, there is worries about inflation from all this money printing, right? And when we talk about the US as a reserve currency, I'm a little less worried there. And here's why. I do think we'll probably see inflation in the year ahead. I don't think it's going to be hyperinflation. The big worry is, modern monetary theory, or basically just the Fed is going to buy any U.S. Treasury debt. We're just going to monetize our way, to basically being Argentina, right? Or, wherever it is. I think when we see something like major new entitlement programs, like, let's say a Green New Deal or universal health care or whatever these, one of these really big ticket items from a policy perspective, that there's no way to fund it with taxes in the United States. There's just no plan. So when they put these things forward, basically the implicit idea is that the Fed's going to do this. I think that's when we get into really dangerous territory with a reserve currency, because other countries are going to see that, and they're not going to hold dollars and basically pay for our social welfare programs in the United States. I think that's where we get kind of a 1970s type run on the dollar. And that's, remember, when they closed the gold window and things like that under Richard Nixon. So, but, that being said, and there are worries about these kind of big programs, though, now looking at the political situation, the Democrats control the House, the Senate, the executive branch, but they really don't have the margins to pass things that big, from what I can tell. But here's the other thing with the U.S. reserve currency, right? Typically for a reserve currency to shift to a new country or entity, there has to be a major, worldwide event. And, maybe you could say a pandemic is that, but remember, the United States took the reserve currency status from Great Britain after World War II, well, basically during World War II. And it has a lot more to do than just how much money you're printing, because every country in the world is printing money right now if they have a central bank. So it's not just the US doing this. So from a relative standpoint, the dollar doesn't look that much worse. And really the big asset for the United States is military status and the fact that we patrol the sea lanes and we have all the aircraft carriers and things like that. So barring some type of major war, and that's typically how these things shift, I'm not worried about the reserve currency yet. Though, I think once if we keep following kind of the modern monetary theory path, I think that's where things get kind of more worrisome. But kind of the flip side of that, that kind of darkness and kind of negative view of things is that in inflationary environments, real estate is actually a great investment because obviously you're able to kind of raise the prices as you go, right? To kind of raise prices with inflation. And there's a lot of things, like a US Treasury bond, you're going to get wiped out if there's inflation, right? Real estate, not so much. So real assets tend to do pretty well when it comes to inflation. Obviously, if you're going to be buying and selling properties, the multiple you're going to get on cash flows is going to go down. But from an income perspective, you're pretty well protected in real estate. So, I think from those terms, if we are kind of worried about inflation going forward, try to get into real assets and stay away from, nominally denominated debt securities, like bonds or U.S. Treasury debt.
Yeah, no, that's good because oftentimes we'll hear exactly what you just provided is commentary or is feedback, but then trying to translate that into how does that affect us as real estate investors, which many of the folks that are on the line, in fact, are. So I'm glad that you said that last piece too. So investing in real assets, the path that we all have pursued, seems to be something that we would want to continue to do. So really glad to hear that. On the topic of all-time sort of low interest rates, Bryce, if you looking into your crystal ball, how long do you continue to see that taking place? Is there any type of adjustments that you would anticipate occurring to change that?
Yeah. So, and this is kind of one of the things I'm talking about, how there's been kind of a shift towards home ownership, right? I think it's important that we keep in mind that the interest rate situation and mortgage rates specifically are a big reason why this shift in towards, owner-occupied property has happened, right? It's just easier and cheaper to purchase a house. Kind of the outlook for interest rates. Well, on the short end, the Federal Reserve has said they're basically going to keep interest rates at zero, probably till 2023 or 2024. So on the short end of the curve, I don't really see anything happening for several years. Now, on the longer end of the curve, the Fed doesn't control the 10-year Treasury rate. They have some influence on it, but I think if we do see kind of an increase in inflation, which is likely in 2021, I think you'll start to see the 10-year rise. I think you'll start to see mortgage rates rise along with that, and that should, that if that does happen, again, the multiple that you're going to get for a property will probably go down. But again, your general cash flow is going to go up with that. So, you're going to be able to kind of price in that cost of living increase. So, I think basically that's going to, if that happens, it would probably benefit, rental properties more so than it would, owner-occupied housing, right? If mortgage rates are going up, people are going to be looking back towards renting again, just due to the affordability issues that it's going to cause.
Yeah, that makes sense.
Okay, and here my last thing here, guys, is that we're talking about. I talked about how kind of I'm under an inflationary environment. Real estate is a good investment, but real estate's also a good investment in the United States because we don't build anywhere near enough housing at all. So what I've got here is housing starts, both single and multifamily, as a percent of the total number of U.S. households. So basically, what I'm doing here is I'm population adjusting the amount of housing we're building. And I'm specifically population adjusting it for people that identify themselves as a household. So that could be a single man, that could be a family of 5, right? But regardless, those people are going to want their own living space. So what you can see here is basically, this is an ongoing trend for like 70 to 80 years. The amount of housing that we build in the United States has been consistently falling. We had a huge decline in 2008, 2009 for obvious reasons, right? That's the housing bubble. But, and we've been crawling back, and we've been building more than ever this year, when you look at recent history. But if you kind of look at it back to 1959, even the recovery that we've had over the past 10 years from 2008, 2009, we're still building probably 1/3 of the amount of housing that we were back in the 50s and 60s. So the reasons for this is that, housing is the most regulated industry, probably aside from healthcare, in the United States economy, right? There's tons of issues with local zoning. There's, environmental impact studies. There's, setbacks from the street. There's mandatory parking that you have to put in, right? The list goes on and on. And especially in big cities like San Francisco, where in New York, there's just a ton of regulations that keep us from building more housing. So, I think, the population is going to continue to grow in the United States. Even with kind of the birth rate falling, we have a lot of immigration, and that keeps our population growing. We're just not building enough housing units to meet demand. And I don't see that changing anytime soon, because, how are we going to get rid of all the regulations that are kind of slowing things down? We aren't. Probably we'll layer more on top. So from that perspective,
Bryce,
again,
I'm sorry, Bryce, real quick. So would you say that this is market specific? I know for a period of time, for example, Houston was considered to be overbuilt, and absorption there was not very high at all. Certainly the supplies generally across the U.S., it sounds like, but are there certain markets that come to mind that that this is most applicable to, or not?
Yeah. So absolutely. You mentioned, I think Houston was like the #1 city for, population adjusted housing. And the reason is they had like no zoning regulations, right? So
exactly.
People were building houses in like floodplains and things like that.
Right.
But, generally speaking, the reason that this has been happening is that the major population centers, the U.S. has been basically undergoing urbanization for decades now. Everybody's moving to the big cities. In the 50s, everyone was fleeing the big cities, 50s, 60s, 70s, going to the suburbs. We've basically seen that reverse in the past few decades. Now everybody's heading back to the cities. And the cities are the places where we're not building at all, right? So, I think, again, suburbs, kind of smaller mid-sized areas, like if you go to Nashville or you come here to Austin, you're going to see a ton of cranes everywhere. And I think kind of, that's a big draw for a lot of these kind of newer mid-sized cities, is that housing is actually available for people. Whereas, you go to New York or you go to San Francisco or Chicago, it's much more difficult to find new builds.
Got it.
So I'll wrap it up there, guys, and we can do some Q&A. But I do want to just, really quick say, if you want to get in touch with me, the best thing you guys can do is you can just Google the First Trust Economics blog. All of our stuff's there for free. All of it's public use. So subscribe to that or follow that. That's a great way to get our reports on a weekly basis. You can follow me on LinkedIn. Bryce Gill First Trust. I post everything on LinkedIn. That's kind of where I do all my stuff. I feel like LinkedIn, is I have a Twitter account, but I feel like Twitter, just the discourse there is kind of more toxic, right? I mean, it's a lot less professional. So I try to keep it on LinkedIn for the most part. I'll post everything we write there, and then you can always email us to it, economics@firsttrustadvisors.com. So with that, I'll go ahead and turn it back over to Christian, and we can do any kind of Q&A that you guys have.
Yeah. Hey, thanks, Bryce, and thanks for putting your contact info there. That was going to be one of the questions I asked, is how people can get a hold of you. As Bryce mentioned, guys, if you can submit any questions that you may have for him as we look to wind things up, that would be great. I have a couple others that I want to ask now. I'm continuing to hear, Bryce, about negative yield bonds. Can you speak to that at all? How does that work exactly? And for which type of investor would that be of interest?
Yeah, so negative yielding bonds really popular in Europe. There's, I haven't checked what the recent balance is, but we're talking tens of trillions of dollars in negative yielding bonds across the world. And who is it for? Well, I think it's for basically two kinds of people. One is going to be, if you're a trader, right, and you're looking to make capital gains in the fixed income market, which I wouldn't recommend that, but basically you're front running central banks across the world, right? You're buying it thinking that the interest rates are going to go even more negative. So if you want to like trade on central bank policy, I think that's kind of there's probably opportunities there. The other people that it's for is for major pension funds and kind of institutions that are legally required to hold sovereign debt. So if you kind of look at the breakdown of who owns all these negative bonds, it's not retail investors for the most part, or even people in their 401ks. It's basically pension funds. So like city employees across the world and municipal employees across the world who they write regulations into these contracts that basically say you have to purchase sovereign debt, and if it goes negative, guess what? You still have to buy it. So, basically, what's happened is that Europe, especially, and the reason why they're kind of in this situation is, Europe has a shrinking population. Their demographics are very bad. Same with Japan, and at the same time, in my opinion, basically they've stepped away from capitalism and kind of the engine that drives productivity increases and innovation and more towards kind of the redistribution side of things. That's basically where state policy is pushing them. And when you look at those two things come together, where not only is your population shrinking, but they're becoming less productive, it kind of makes sense that there would be negative yielding debt, because if you look at the economies as a whole, they're negative yielding, right? Basically, or are expected to be in the future. So, I don't think we'll see negative yields here in the United States. One reason is because we're the reserve currency, and no one really knows what would happen if, the dollar that every other banking system is built off of went negative. No one has any clue what would happen. But the other side of it is, this is also, back to kind of the philosophical side of capitalism, where it's, it has to have creative destruction to work. And basically, when central banks are going to intervene during every financial crisis, or, this time around the pandemic, I thought it was actually appropriate because we're shutting down entire economies, right? So that's kind of a takings clause situation from the Constitution to me. But, I guess basically what we've been doing is, our time horizon has become more and more, shortened. So we're worried about today, right? Well, if this company goes under, X number of people will become employed, and we don't think about kind of the future, where if you're constantly lowering interest rates, basically what you're doing is you're zombifying your entire corporate sector. So they're paying their debt with more debt, and that's basically what's been happening. So that ties up a lot of productive resources, namely, human beings are the most productive resource there are, right? Smart, innovative people kind of at these older companies where, if those companies went out of business, those people would go to greener pastures and maybe start a new company that was, driving innovation. So, from a philosophical standpoint, negative interest rates are, it's the result of kind of being short-sighted, in my opinion.
Yeah, I mean, a lot of what you just said brings up a couple of different topics. One being robotics and automation, things like that, as a replacement for human capital. And we don't need to go there necessarily, but I don't think you can have a discussion on currency these days without at least broaching the topic of cryptocurrency and its potential impact. Any thoughts on that as you look out into the future here?
Yeah, so I was talking about inflationary pressures, right? And Bitcoin is a great example of that. Bitcoin is like above 40,000. It's been surging lately, and the reason is people are worried about inflation from government printing money and just sending out checks to everybody. That's again, it never ends well, right? If it is truly for this temporary kind of pandemic situation, that's fine. I get that, but if you really are going to just do the kind of the model of money for the people, which is look at Argentina as the best example, right? Where the central bank just starts funding government spending and checks to everybody. It never ends well. It basically causes a spiral in the currency. And that's why Bitcoin is doing well, is everyone sees central banks across the world following the same path. And Bitcoin, it has a fixed supply. So it's basically the hardest you can get in hard money, right? There's also, privacy concerns and things like that. But and there's tons of people hopping in just because it's a speculative asset, right? But I think the big core of it is people worried about, fiat currency systems across the world. So I think that's the reason why Bitcoin's been doing so well this year. Same thing. Look at commodity prices have been rising for the past 6 months. Look at inflation break-even numbers have been rising. That's kind of like a market-based measure of inflation expectations. So broadly speaking, it seems like the market agrees that there's going to be inflation. Now, again, I don't think the U.S. is going to have hyperinflation like Zimbabwe. I don't think it's going to be even as bad necessarily as the 1970s. And the 1970s, what were we doing? We were printing money to fund the Vietnam War and then Lyndon Johnson's Great Society programs, right? So, Medicare, Medicaid, Social Security expansions, things like that. So those kind of big programs, like I said, that's where you get worried about kind of a repeat, like a total secular shift in inflation, is when the central bank just starts funding either wars or entitlement programs. And obviously, you look towards the future, and we're talking a lot about these big programs and kind of solving society with government policy. And at the same time, tensions are ratcheting up with China. So I think that's why people are getting more and more worried about inflation.
Yeah, it's interesting how it's all sort of tied together. I'm hearing of various companies producing different versions of cryptocurrency, even sovereign nations pursuing that path as well. Are you seeing that, and what do you anticipate sort of the potential impact that could be as well?
Yeah, so I mean, I think that those kind of sovereign nation cryptocurrencies are going to be a complete failure. They're not going to work at all. And the whole reason is, the point of cryptocurrency, and really, it's the point of Bitcoin, right? No other major one has really caught on. The point of it is it's digital gold. There's a fixed supply of it. They can't, print more of it. And it's going to be a government that issues a cryptocurrency. Like, I think Venezuela has like an oil-backed cryptocurrency. I mean, you'd have to be insane to get involved with the Venezuelan cryptocurrency. Again, you might be smarter than I am, and you can, trade it and make a ton of money. But the point of the reason Bitcoin's doing well is it has a fixed supply. And the last thing I would talk about with the reserve currency thing, and the reason why the United States is kind of in a good position is, again, there has to be somebody to take the reins from the incumbent, right? And I don't know who that would be right now. You have China is kind of the second biggest economy, right? But the reason the United States dollar is so well respected is because we have very strong property rights in the United States, right? In China, billionaires go missing, every week. So what major investor is going to put, $100 billion in Chinese currency? With the capital controls, with the problems with property rights, I don't see that happening. I don't see them replacing us. And the other one would be, I guess, Europe. If Europe could really kind of finish the EU project and become kind of like a unified super state with kind of, parallel fiscal and monetary policy, and they were issuing tons of debt, maybe Europe could do it, but they're not. I mean, they're a broken union. They can't agree on anything. The South and the northern parts of Europe have tons of problems with each other. England just left. So I just don't see what, sovereign entity in the world can replace the United States at this point.
Got it. Okay, I don't have any additional questions for you, Bryce. I'm looking to see if anyone else has posted a question. Oh, looks like one just came in now. Actually, two had come in while we were talking. So the first one is for investors. Any thoughts on self-storage properties? I am interested and have friends. Still thoughts on if still like single family investing. Okay, so I think the spirit of the question is basically just understanding whether, single family investing is still a good prospect. I think you addressed that earlier. Any thoughts on self-storage, as this person seems to be interested? I'll weigh in real quick on that, and then Bryce, you can feel free to do the same, and then we'll ask the last question before we end here. Self-storage to me is highly correlated to multifamily in a lot of ways, simply because it seems like as folks are transitioning, at least for the trends that were occurring prior to this recent shift, as folks were transitioning from, the single family home space into multifamily, unless you sort of completely sell everything off or most of it, you got to have a place to store it. And as Americans, typically we like to keep our stuff. And so self-storage seems to have been increasing over the course of the most recent term here. At least that's what I've been observing, and actually had become interested in pursuing that, looking at those as potential investments for us as well. Bryce, thoughts on that?
Yeah, I've never really looked into the self-storage stuff as much, but I think your theory kind of makes a lot of sense. And the other thing I'd say is, anybody that's basically downsizing. So a lot of, kind of older Americans that are either, they're selling their huge home they raised their kids in and kind of moving into a smaller place, or, they're retiring and going to, an elderly, residency facility or whatever. I think self-storage makes a lot of sense in those places, and probably big cities too, where, if you're moving from the suburbs downtown and you have a lot of stuff, I think self-storage makes sense in those situations. So yeah, I'd say it's like a downsizing kind of phenomenon, probably.
Sure. All right, and then last question, what do you foresee you touched on a little bit of this, but maybe just readdress it here. What do you foresee on the economic and job growth in the near future, with high number of unemployment due to business permanently shut down? I imagine there's a major short-term and long-term impact, especially on the lower income segments.
Yeah, so this kind of correlates with my first slide, the kind of winners and losers of COVID-19. The places that have reopened faster, and you can make arguments and say, hey, they did the wrong thing, or it was better to be more cautious, or whatever it is. I think everyone's entitled to opinion, but the economic data makes a pretty clear case that the states that reopen faster have recovered much more quickly than the ones that have been more strict with pandemic restrictions. So I think we're going to kind of see an economic recovery that's more protracted in those places. Then, in California, it's going to take them longer for the labor market to recover than in Texas, for example. And the big issue with, especially right now with people, the lockdowns ongoing in places like California, is that, in Texas, things are mostly open. Businesses can begin to reopen. They can rehire people, even if they have to be careful, even if they have to operate at 25 or 50% capacity or whatever it is. At least they're in business. In California, and all these businesses are going to disappear. And basically what you have is you have more permanent scarring on the economy, right? So whenever things do reopen and things get back to normal, now instead of just, hiring more staff and ramping up the operation that's already going on, even if it's, very, 25% capacity, now you have to start from scratch, right? You have to get an entrepreneur to go get a bank loan, to do all the interviews, to find a property, to get the permits and all that stuff. And what that basically shapes up to is, if they're not leaving the state already, it's just going to take longer to basically reconnect all those different people together and start businesses back up. So I think basically what you're going to see is a more protracted recovery in kind of the East Coast and the West Coast, and kind of the south of the country is going to rebound the quickest. And that'll show up in, wage gains. It'll show up in, employment gains and things like that in general. But I will say, even with, I do think there's going to be a divergence there. Generally speaking, 2021 is about to be an extremely positive year for the U.S. economy. I think we're going to see job growth massively reaccelerate in 2021, especially in the spring and summer as the vaccine is completely distributed. I talked about the stimulus. People have been saving money like crazy. There's like $2.5 trillion extra dollars in people's bank accounts. I think people are going to be spending on the leisure and hospitality services that they were unable to spend on in 2020. So I think we're going to see a very rapid recovery in 2021. Maybe we're not going to get back down to 3% unemployment nationwide, I think that's where kind of the regional divergences are going to come in. But I think generally speaking, yeah, things will bounce back pretty quickly. And yeah, the disproportionate beneficiaries of that are going to be, lower income people that work in services that have been the ones that bore the entire brunt of this pandemic kind of recession. Because, for the most part, if you could work from home, or if you're a white collar person, you probably cruise through this thing pretty well.
Right. Well, hey, listen, let's go ahead and end there. Bryce, thank you so much for your time here on Saturday morning. Thank you to our attendees. You certainly provided a lot of value to our guests here, Bryce, and certainly appreciate that. Look forward to continuing to connect with you. Good luck with the rest of the MBA program there at UT, and happy to connect some more. But thank you for the time now. Really, really appreciate it.
All right. Yeah. Thanks, Christian. It was great. Great talking to you.
Okay. Thanks, everybody. God bless. Take care.